Vanguard ETFs have always been kind of the gold standard when it comes to low cost and low risk investment vehicles. And some of the more popular Vanguard ETFs that you've probably heard of are VOO, which is the ETF that tracks the S&P 500, and VTI, which is very similar to VOO, but instead it tracks the entire stock market and obviously has a lot more weighted holdings. Then there's VYM, which is the Vanguard Dividend ETF. That's another one that, again, is perfect if you want something that is low cost with low volatility and consistent dividends. So those are kind of the classic Vanguard ETFs that are great for passive, stress-free investing. But there's another ETF that I wanted to talk about today that's in the Vanguard family, but a little different from the ones I just mentioned. It's called VGT, or the Vanguard Information Technology ETF. Now, the reason why I say it's a lot different than those other Vanguard ETFs is because it's very non-diversified and targets only one sector. And since it targets the tech sector, the risk and reward is much higher. So whenever we have a rally like we did at the beginning of 2023, that's when the turbo kicks in for this ETF. Its year-to-date return as of right now is 35%, with a 5-year return of 135%. And comparing it to other indices, we can see that over the 5-year return, VGT nearly doubles that of the S&P 500 and still beats out the NASDAQ as well. So the growth is definitely there for VGT, but let's talk about why for a second. If we jump into its top holdings, you'll notice that Apple and Microsoft make up a huge portion of the fund, with Apple being weighted at 22% and Microsoft being 16.5% of the fund. So just these two stocks make up around 40% of the portfolio. And as you probably know, both Apple and Microsoft have performed extremely well over the past decade or so. Then you have Nvidia, which makes up 6.5% of the portfolio, and it's had insane growth this year as well, with a year-to-date return of 220%. So needless to say, the stocks in this portfolio are extremely fast growers, especially when the market is green. What I thought was interesting too, when you go to VGT's webpage, Vanguard gives a little warning here, basically saying that this is a higher volatility fund and is subject to extremely wide fluctuations in share price. So again, just a typical high risk yet high reward type of fund. When it comes to the expenses, it has a 0.1% expense ratio, which means you're only charged $10 for every $10,000 invested, and that's a lot lower than other similar ETFs. And like I mentioned earlier, that's the beauty of Vanguard ETFs. Their fees are so low that they have little to no effect on your long-term gains. So we just saw what's inside this ETF and some of the companies that make up the portfolio, and you might have noticed that a lot of the stocks in it are software and semiconductor companies, and they're not really known for their high dividend yields. So VGT still pays a dividend, but the yield is only 0.77%, with each quarterly distribution being anywhere from 60 to 90 cents per share. And even though the dividend yield is pretty low, the potential gains that the fund offers definitely would make up for it. With that being said, let's now backtest VGT to see how much we'd have today if we were to have invested back in 2010. So this is assuming we invested $10,000 back in 2010 only into VGT, while also contributing an average of $500 a month, which in my opinion is fairly reasonable. So today, at the end of those 13 years, you'd have just under $450,000. But a few things to keep in mind here is that your worst year would have been in 2022, and your portfolio at its lowest would have been down nearly 30%. So that is assuming you didn't panic sell during the rough year. Plus, from 2010 to about 2021-ish was arguably one of the most consistent bull runs we've ever had. But regardless, this still goes to show how much growth VGT experiences whenever we're in a healthy bull market. So now you might be wondering, what are some other ETFs to pair this with if you prefer a little more diversification? And like I mentioned at the beginning, you really just can't go wrong with Vanguard ETFs like VOO or VYM. So those two are definitely solid options. But the one I think that would be the perfect match for VGT is actually not a Vanguard fund, but a Schwab ETF called SCHD, which I'm sure most of you are very familiar with. And the reason why I think these two would be great together is because SCHD is a dividend growth ETF that increases its dividend every year, and it's also extremely diversified. If we look at the overlap between the two funds, there's almost no similarities when it comes to their holdings. There's only a 7% overlap, which is all the more reason to pair these two ETFs together. But that, of course, is just my opinion on which ETF I think would be the best sidekick for VGT. And you can always decide on how you would want to split them, whether it be 60-40 or 50-50. And for me personally, I'm a younger investor, so I do have a bigger timeline. So it is a fund that I would find captivating, but let me know in the comments below what you guys think of VGT and whether or not you're buying right now for that high growth that it comes with. Also, feel free to check out some of my other videos, and I'll see you guys next time.